Trade activity contracted for the first time in 3 decades last year, according to the World Bank. As a result of the financial crisis, emerging markets and African economies could see a gap in trade finance of between $100 and $300 billion. That's why the International Finance Corporation, IFC, which is the private sector arm of the World Bank, is teaming up with Citibank and the African Development Bank in an effort to boost trade in Africa. For more, I'm joined by Germán Vergara, Senior Manager at the IFC. Germán, thank you so much for being with us on CNBC Africa today. I wanted to start out by asking you about this threat of a contraction in trade activity and trade financing. How serious is this threat for African countries?
We actually saw the contraction of trade last year for the first time since the last depression. We are expecting the situation to continue stabilizing a bit in certain markets, and I would say that Africa in particular, it's become more of a country issue. Certain countries have improved dramatically. The lower income countries or less developed countries in Africa are continue to seeing a depression in trade flows.
But what does this actually mean for importers and exporters? How does this affect them in a day-to-day basis as far as their business is concerned?
Well, trade is the working capital blood basically for many exporters. So without the availability of trade finance, the trade will not happen. So in other words, the exporter will not be able to sell his or her product. So the opportunity to create better financial intermediation through, for example, GTLP, where we are mobilizing public funding to support commercial banks to increase their lending to these SMEs, will allow the SMEs to export their products.
Now, the IFC already has in place a global trade finance program totaling about $3 billion. Can you tell us a little bit about that program, how it works, how successful it's been so far?
So IFC has 2 programs in place. One is the GTFP program, which is basically a program we established 5 years ago. And last year we dispersed a total of $3.4 billion in guarantees to support trade. Last year, we launched the Global Trade Liquidity Program, or GTLP, with a number of partners like the African Development Bank. And the program was set up basically to mobilize liquidity from public and government and DFIs entities into the private sector through commercial banks like Citibank, for example. So this is what we're signing today is a solution via GTLP, which will provide liquidity through Citibank to partners, to commercial banks in sub-Saharan Africa.
So what about this new agreement you're announcing here in London with the African Development Bank and Citibank? How does it fit into your already existing trade finance program? Are you actually providing incentives to lenders to increase their lending for exporters and importers?
So what it works is the $300 million is composed of funding from the African Development Bank and IFC. So jointly we're providing 50%, so a total of $150 million. The Citibank is providing the remainder, so a total of $300 million. These are basically, will be used by Citibank to support on lending for trade to its network of correspondent banks in Africa.
Germán, you talk about how your global trade finance program has been in place for a number of years. Can you tell us how successful it has been so far? Are there any examples in Africa that you can tell us about where this has actually helped?
Well, I think we have very good success stories. We have, for example, for the first time, IFC has been able to do transactions in places like Sierra Leone, where in the past we've been unable, because of the size of the banks, unable to provide them long-term finance. Trade finance have provided basically a window for us to be able to help the lesser developed economies. So this is a success. We have examples over and over again of trade finance being sort of the bridge for IFC and other institutions to do more in the lesser developed countries in Africa.
Germán, if I can just turn to your first answer where you talked about a stabilization in the decrease in trade activity, as in we saw a contraction in 2009, but things look like they're stabilizing in 2010. That sounds like good news, but are you not concerned about these fears of a double-dip recession, especially in the Western world, potentially having a negative effect once more on trade activity? To what extent is that a threat right now?
We have to remember where we were 16 months ago, and I think we tend to forget, we have a very short mind, that about 16 months ago we were really in the edge of a major depression, which was basically through the role of the G20, a number of governments. I think that depression has been avoided. By stabilization, I mean that we've obviously crossed that. We're in a much better position, but nonetheless, I think what we've seen over the last few months is a roller coaster. I think sovereign risk and a number of other risks that continue to appear, that is creating the need for continued activities from institutions like the African Development Bank and IFC to continue supporting trade. So I see that there will be continued demand for public-private interventions to promote trade finance in the emerging markets.